Hello, George Markowski coming to you live for the Positive Property Show, live in our group, the Australian Property Investors. Grab yourself a cup of coffee or a glass of wine and check the timer up here. If you're watching live, type in #live, just so I know you're there and you're watching. And many of you watch the replays, so please type in #replay so I know that you've watched this video. This is about investing in property and creating financial freedom. This is for our Freedom Tribe. So if you want to invest in property, you want to create freedom, you should be watching this, so pay attention. But if you get offended easy and you're a snowflake, I suggest you switch off now because it's probably not for you.
My mate George here, he retired at the age of 37 by investing in property. Mate, I feel like I'm with royalty today.
I think George is a great mentor because he really does care. The George I know, I met him 3 years ago, he does care. That's why he does his work. So I can talk to you about cash flow and all those things. George is better at that than me.
Property guru George Markowski from Positive Property Solution joins us now. George, good morning to you.
How are you, George?
Okay guys, me and my team are about to go live, so make sure you grab your beverage of choice, sit down, and you're in for an amazing show. Hello, hey Kumar, and welcome.
Welcome. Thank you.
Hello everyone. I'd just like to say thank you for joining us. We're doing a live from around the world. I'm going in from Bali, and we've got Kumar, who's part of our Circle of Safety accountant, coming in from Adelaide. So good to see you, mate.
Same. How you doing?
Good, very good, very good. It's nice and warm here. I just caught up. What I'll do is just tell you an interesting story. So I just caught up with Louise and Dave Dove. They actually joined our program about 3.5 years ago. And yep, they're on to property number 6 at the moment. And we just caught up for lunch actually and talking. And if everyone knows, what happens is we've got the black belt program. So when you start, you get the white belt, and then you get a yellow belt, and we keep going up. And once you've got 10 properties, you end up with black belt. But there's another thing that we do as well. When someone exits the 9 to 5 and takes control of their destiny, then they get the katana. This is actually a sword, the same sword they used in The Last Samurai. And Louise and Dave, they're going to be getting presented the sword this year because they've actually exited 95, which is very exciting.
Wow. Congratulations.
Yeah, it's pretty cool. So we're going to talk tax. We want to talk tax. We're going to talk about property tax. And, this is the thing. One thing a lot of people don't realize, and this is the important thing, is there's 2 things that you can't avoid. And that's taxes and debt, right? Debt and taxes, that's what they say. And look, we don't want to avoid tax because that's not what we're into, but we do definitely want to minimize it because, you look at, what's his name? Kerry Packer. He once said when he was in court for not paying any tax, he said, if you don't minimize your tax, you need to get your head read. You're stupid. And that's what it's about. Now, unfortunately, if you're 9 to 5, you've got a small business, you don't get the same tax write-offs and same tax the wealthy do. Because what happens is there's 2 ways of saving tax. Number 1 is actually lose money and save tax. That's what the poor people do. What the rich people do, what the wealthy investors do, is we actually lose money on paper and save it that way. And it's infinitely better because the biggest thing that's going to happen to you in your life, the biggest expense is going to be tax throughout your whole life. There's no more money you can spend anywhere else. So talking about that, Kumar, let's talk about how we deal with tax and what we do when it comes to properties.
Yeah. Like you said, 100%, couldn't agree anymore. Tax is important, and so is death. I guess those are 2 most important things you can't avoid. But with regards to from a tax deduction and in property related, there's multiple ways that we can get tax deductions using without expensing money, which is depreciation. depreciation is something that most property investors would get by acquiring new property, or like in the past, we used to have depreciation for the capital assets of any assets that were purchased pre 2017. You were able to depreciate that over a number of years. However, now the new rules are only for assets that are purchased either new or bought as a brand new property is what you can depreciate. And how that works is, as an example, if you've got a rental income of $20,000 and you've got overhead expenses of say $5,000 to $10,000, and let's take your capital depreciation with an additional $10,000, which you don't actually have to expense for on a yearly basis, that gets added onto your expense to reduce your profit down. So hence that negative and that losses will offset your PAYG revenue to reduce your tax. So that's one of the ways of how property, you can get a deduction from properties. Yeah. So
Great. And look, what I want to discuss tonight is the one thing that I tell everyone actually is the first thing you want to do when you're investing in property is get a strategy that's going to smash down your tax, because that's your number one expense for the rest of your life. Because on average, if you buy a brand new property now, you can get average of $80,000 over the first 10 years in depreciation.
Yes.
That adds up. We actually had a client, and this is the interesting thing: when you make money, capital growth, equity, you don't pay tax on that, right? And you can actually refinance, take the equity out, tax-free, and get a tax deduction for the loan. And on top of that, if you could actually, we've got a client who lives in Bali. His name's Barry, and he bought 5 properties about a year ago over that 2-year period, and they went up around about 700,000. So he made $700,000 in profit, but at the same time gained, I think it was like $500,000 worth of tax deductions, which is pretty cool. So very exciting. Now, I want to talk about ITWV, because a lot of people don't understand that, and they don't understand, because what happens is I talk to people and go, would you rather get your tax back weekly or in one lump sum? And everyone's like, I want one lump sum. But a lot of people don't understand that with money shrinking. Yeah. And if I delay getting my money for a year, it's not the same money. So if the tax department is supposed to give me 10 grand and I get it every week, I'm actually getting more money than if I wait till the end of the year and give them a free loan. Can you explain how that works?
So pretty much, George, what ITWV, how it works is, for those that don't understand, haven't done any of those before, is we're typically requesting as a lodgement to the ATO, saying, submitting a form with what expenses they will be incurring on a yearly basis, which typically we would only do at the end of the year once you meet a tax agent or an accountant to submit your tax return, as previously mentioned about incurring the losses. So we do an estimate in advance to say to the ATO, I'm estimating my rental property or any other investments is going to incur a loss of X, say as an example, $10,000. So if the information provided the ATO is granted by the ATO, so the way it works is they give you a notice from to submit to your employer to say, based on your estimated deductions, we're going to reduce your tax withholding by that percentage of reduction in expenses. So which then gives you back more tax. So what then that allows you to do is your employer no longer withholds, as an example, 32.5% or 40%. They will be reducing that to the actual correct calculated rate, giving you more tax withheld back to have disposable income to then reinvest back into your future investments.
And that really, a lot of people say cash is king, but my view is cash flow is king. And that's why I like the ITWV. And what we're finding at the moment is one of our average members, they're normally getting $85 a week back in their pay packet per property.
Interesting.
Right?
Yeah.
Now imagine, who would love to get $85? Type in hashtag $85, because imagine getting $85 for each property you buy. Instead of, when I first started investing in property, I was getting the wrong loan. and I didn't even know what an ITWV was.
Yeah.
And I was minus $300 a week per property.
Yeah.
Which was very hard.
Yeah. Definitely a good option to and it also used, as what you said, like, to increase your cash flow to help you to further invest in another property.
Yep.
Yeah.
So when it comes to property investing, not every accountant knows all the tax deductions. And why is it important to get someone that knows what they're doing when it comes to ITWVs? Because one, I've noticed a lot of accountants don't realise you have to redo it every year. And then people forget, and then they haven't done it.
Of course.
So why does someone need to talk to someone like yourself, who's an expert when it comes to property investing and knowing what tax deductions to claim and what not to claim?
I guess, correct me. So if you're not aware of what sort of deductions you can claim if you submit the wrong form to the ATO, or as you said, not submit the form correctly. One, if you're not claiming all your deductions, you're really not reducing your tax withhold amount correctly at the time that you most require it. And possibly when it comes to tax time, when someone does your tax return and notices that you've misclaimed an amount for certain deductions that you could have actually claimed, but you've omitted that from the ITWV, that could have actually helped you with the reduced tax withholding as you submit it to the employer. But also, if you don't do it every year, as what you said, now all of a sudden, come the following year, your PAYG withholding is back to the original, and you'll be back in the negative rather than having a reduced tax withholding.
Yeah, what would be really handy if we had a checklist of what you can and can't claim, a nice simple one. That would be really handy.
Yeah, we do tend to. So a lot of the way we engage clients, we typically have a standard checklist in that we provide to clients that we engage. If they have a property, we would give them a standard list of expenses that we would usually see. Typically, your standard rates, taxes, power bills, water bills, council rates, and any other rates that are applicable for different states, any capital improvements that are made, any repairs and maintenance, and so on and so forth. But also a big thing is things like, if they have any membership fees for education fees and that related to the property deriving income, that can be all deductible. So that's typically what we provide to the client to give it to us in a summary, and typically also say, just give us a list of all the things that you've expensed for the property for us to then ascertain if they can or not claim that.
Yeah, what a shame, because before 2017, people could fly to their property twice a year and get a tax deduction, which everyone loved, because a lot of our clients have property in Queensland, and they've done very well out of them. They used to go to Queensland twice a year, check on their property, have a bit of a holiday. It was pretty cool. And it's a shame that the government just sort of slammed that. Now, look, I know why the government stopped tax deductions for second-hand properties. I get that, because the deal is, we have got a lack of properties at the moment, a massive lack of supply. We've got 100,000 less properties than what we need currently. We've got 1.5 million people moving in the next 5 years. That's like building another Perth in the next 5 years worth of people. So we have to really build as many properties as we can. And it's a bit like with the gold rush. The people that manufactured the picks and the shovels, they made millions. Well, this is the gold rush of people coming. The people that are going to provide the properties and buy properties as investment are going to make millions as well.
Yeah.
Yep. Someone's saying, will there be a boom coming? The next boom, I'm calling it the boom that no one is talking about.
Yep.
Yeah. So what about deductions that you don't foresee or are not on the original ITW? Can you claim later?
Yes. So like I mentioned before, so if you have omitted certain deductions in your, look at the ITWV as more of an estimated lodgement. So all you're doing is saying, hey, the ATO, here's my estimated income and estimated expenses of what I forecast my future for the future financial tax return. Can you please consider this and reduce my taxable income accordingly, and apply this new rate for the future income rates? However, if you've omitted a certain amount in the lodgement, we're still going to add the actual correct income and expenses when we lodge the tax return. And if it does work out to be any lower, then there'll be also a further refund back to you. Or you've overestimated and actually put more into it, then unfortunately you'll have to pay back the ATO. So
yeah, but it doesn't matter. It means you've got a free loan anyway. But the key is what we find is, we do the ITWV, then we send them to you, and you always find the different bits and pieces they've missed and get it done.
Correct.
So that's the exciting thing.
That's
one thing I really like and respect about you, Kumar, property investing, and you understand how to do it properly, because I don't want to deal with a cowboy out there that's going to deduct something that can't be deducted either. Because anything I do, I want to be proud to show the tax department, and you don't want to do anything dodgy. You want to only do legitimate tax deductions, because there's plenty there anyway if you do it properly, if you know what you're doing. You don't need to do anything dodgy. You can do it all straight down the line and get good deductions.
Yep, 100%. Totally agree. And we also guide a lot of our clients. Like I said, if there's clients that have any questions, we typically say to them, rather than doing something and then coming to us after, give us a call or send us an email, and we'll respond to it pretty promptly.
Yeah. Any other tips?
From a property standpoint, besides the ITWV and the deductions, I guess the other parts of it would be, I'm not sure if you're going down that path, is possibly, considering the whole, I guess from a PAYG earner, the ITWE is probably the biggest things that has been,
Exactly. And small business owners don't miss out. They just do it on how regular they do their best, correct?
Yeah, that's correct.
Yeah, because you don't have to wait till the end of the year.
No, because you do it on a quarterly basis.
That's right.
As you lodge your BAS,
Exactly. So at PAYE, they're going to get it back on a weekly basis. Where someone that does that's a small business owner, it's going to be quarterly. But it's still better than waiting to the end of the year, which is great. Funny enough, we've almost run out of time. We've got 1 minute left. If anyone's got any questions, please ask them, because we're going to go to our private group next and have a chat to them. So if you got any questions, let me know. Is it better setting up a trust?
Well, see, here's the thing.
That all the time.
I know. I didn't want to mention that, but see, my concern with setting up a trust is, as a PAYG earner, your income is yourself. So setting up a trust is not going to really benefit you, unfortunately.
No, actually, it's not only not going to benefit you. If you set up a trust as a PAYE, you can lose potentially $80,000 worth of tax deductions down the drain.
100% correct.
However, funny enough, if you set up the right trust, the right hybrid trust, you can actually have it in a trust and also claim tax deduction. This is a complicated thing that Adrian does for our clients. It's part of our asset protection, but it's quite complicated, because you've got to look at the balance between tax deductions and also asset protection, and you want to try to get that balance, because we want to protect our assets as much as we can. We also want to maximize our tax savings, and to do both takes a lot of finesse, and that's what we do well, because I don't own any property at all, zero, right? But as you know, I do have a lot of properties. I control them, and that's the beauty of it, because I get tax deductions, but they're controlled, and I don't have to worry about anyone suing me.
Yeah, and George, again, because you also manage your, when we're talking for people that have PAYG earning, where they can't really have other entities to stream the revenue. So for me, with trust, like even for myself, I don't own any properties in my personal name, purely for the fact that I'm not a PAYG earner.
Yeah, exactly. And the thing is, what happens is the strategy you use going in is very different to once you build your property empire. And that's why it's important, if you're going to build your empire, is one, protect it, but two, learn from someone that's already built an empire. Because the first 1 or 2 properties, the mum and dad properties that you do in your personal name, it's going to change after that. because then you're going to start doing bigger and better things and earning more money. And when you got more money, there's more risk, but there's more upside and more return.
Okay.
Yeah. So look, I just want to say thank you to everyone for joining us. Kumar, thank you so much.
Welcome,
We're
George.
going
Thank you.
to scoot off to our private group in Zoom and talk to our members. Guys, if you want to find out more, do you have a worksheet or anything else that we can give people, or?
I've got I think I've been speaking to Christina to organise a little summary about myself with my information. Is that
Yep.
to provide? Yep.
Yep.
I'm not
Excellent.
sure.
And
That's yes, with all my checklist. And if anyone's got
yep.
any questions,
So guys, if you want a
super.
copy of the checklist, type in #checklist. And what we'll do is we're setting it up this week. We're going to send you the copy free of charge. Anyone can have it, so you can know that you're getting all the right stuff. And if you've got a different account, just bring it to your accountant, and that way just help you go through it. Thank you so much. I'll see you on the other program. See you guys.
Thank you. See you.